Carbon trading is the buying and selling of emission permits or allowances between liable parties and other market participants. So at the moment, the Australian government is looking at putting in place an emissions trading scheme. A number of companies will have a liability, and so each year they'll have to surrender a certain number of credits. If they're more efficient, they won't use all their credits, and they'll be able to sell some of them into the market. If they're less efficient, they'll potentially have to source more. And the carbon bit of carbon trading is one carbon credit represents 1 tonne of carbon dioxide equivalent, and the trading bit, like any other commodity market, is the buying and selling of those units between market participants, or in the main it'll be the companies that have the liabilities. Cap and trade is where the government sets a long-term target or a cap for emissions, and then underneath that, in Australia's case, it'll be the emission trading scheme will be applied across a number of sectors, and so it's initially going to start with approximately the top 1,000 emitters, and each of those will have their own target or their own cap, and so all of those individual caps will add up to the national cap. And again, if they will trade any excess units they have or any more they need between each other, and in trading those units, they'll allow capital to flow or funds to flow to where carbon or emissions can be reduced most cost effectively. Well, initially those 1,000 businesses that the scheme will apply liability to will be trading emission units, and so the environmental cost of their operations will be built in, and so that cost will flow through into their products, and then it will flow through to society, to all consumers who will potentially pay slightly more for their products, but it will be a very, very minor increase in costs. There's also tremendous opportunity that will come from it as well. Companies have the opportunity to differentiate themselves from their competitors. If they can be more efficient in a carbon-constrained economy, they can potentially capture more market share. They can also develop more emission-intensive, more emission-efficient processes that they can take the IP from those processes and sell them offshore or license them internationally. So it presents a local cost, but there's a global opportunity. New South Wales was actually had the first mandatory market in the world, and then Europe has recently, in late 2004, the European Union developed a market and started trading, and Europe has over 25 countries involved at the moment, and so it's the dominant market globally and sets the price for carbon globally. And they've actually allowed for projects in the developing world to earn credits, and those credits are eligible within Europe for compliance. So, for example, a wind farm in China it will create electricity, but it will also create carbon credits that we can buy, and our customers in Europe can use for compliance purposes as well. So it's stimulated a lot of international trade, and Europe is set to continue with their trading market, but it's extremely important that Australia continues with its plans to put a scheme in place in 2010, because the market is growing rapidly and there's tremendous opportunity for our corporates. But I think if we delay much longer than 2010, that opportunity will start to diminish. If you're a corporate that has a liability, you'll be doing it to manage your liability or manage your risk. Well, the government's currently designing the scheme, and so one of the key things is for all the corporates that will have a liability, they have to understand what their liability will be and then how they can manage that risk. So one of the initial steps is they understand exactly what the liability is, then they find institutions or risk managers that can potentially help them with that. So they'll be buying credits or trading credits to manage their liabilities. So they'll have a portfolio of credits that each year they surrender to meet their compliance obligations. The credits are verified there's a UN program, and here in Australia, international credits are verified under the Kyoto Protocol, and local credits will be verified under the local legislation. So they'll have to be independently verified, and so it'll be quite clear if credits are eligible. I'm sure there are some shonky operators out there at the moment, but they're not in the compliance market. They're in the voluntary market, so they're selling credits from forests in Costa Rica, and you put your money, pay your money on, click the credit card on the internet, and then you potentially get credit somewhere in Costa Rica. Carbon trading is just booming, and a huge number of credits are coming out of Asia, so China and India mainly, and all the entrepreneurs have come out of the woodwork in China, and they're looking for opportunities, and it's great. Capitalism is working extremely well there, and it's developing. Means a huge number of renewable projects are being developed, but at the same time, there are companies aggregating those credits, and some of them aren't managing, under-resourced. They aren't managing their cash flows well, and with delays in the issuance of credits, they've had to put out new profit forecasts which are lower. So there's going to be delays in their credits coming through from projects, and it means that their cash flow projections aren't correct. And I think we'll see quite a few of those international carbon credit aggregators go broke, or they'll have to be bought out. So quite similar to the tech bubble.